11.2 is about recording sales transactions using a general journal. You have 3 objectives. You need to be able to account for sales returns and allowances. You need to be able to post a general journal to the accounts receivable ledger and general ledger. And you need to be able to record a correcting entry to the accounts receivable ledger. So first thing they're talking about is a credit memorandum for sales returns and allowances, and they're really just giving us definitions. So a sales return is a credit allowed to a customer for the sales price of returned merchandise, resulting in a decrease in the accounts receivable of the merchandising business. A sales allowance is credit allowed to a customer for part of the sales price of merchandise that is not returned, resulting in a decrease in the accounts receivable of the merchandising business. A credit memorandum is the form that's prepared by the vendor showing the amount deducted for returns and allowances. So really, this is what we are looking at for our purchases, returns, and allowances. A return is where they are going to return the merchandise, and then we are going to decrease the amount of the accounts receivable. The allowance is just part of the sales price that we are going to decrease. And so it could be that it was not returned. Maybe there was a defect. Maybe it was the wrong color, whatever it may be, but we aren't returning all of that merchandise. And so that's why we do a sales allowance. So really with our purchases, returns, and allowances, that was when we were returning goods to our accounts payable, our vendor. Now, when we look at this, the sales returns and allowances, that's when we have a customer coming to us and they're returning part of the merchandise that we sold, or they're returning all of the merchandise that we sold to them. Here's an example of what a credit memorandum might look like. So we can see this is our company here, our 3 green products. And then here is who is making that return, Lake Automotive. We have our date, we have our number of our credit memorandum, we have the vendor ID, and then it looks like here's what they had, a quantity of 3 of these tool batteries that they're returning. So December 16th, it says that we granted credit to Lake Automotive for merchandise that was returned, $65.85, plus sales tax, $395, from S500 for a total of $69.80, credit memorandum number 14. So they do give us 2 source documents in here. This S500 is the original sales invoice. So that's the sales invoice when they purchase that merchandise from us. Credit memorandum number 14 is what we are using for that return. That's what we are going to use when we are journalizing that transaction. So here's what it's going to look like in our T accounts. We are going to debit our sales, returns, and allowances for that $65.85 because that's what we sold to them that they are now returning. We are also going to debit our sales tax payable. That will decrease our sales tax payable. We don't want to pay sales tax on a sale that ended up being returned. So we want to make sure that that sales tax payable gets decreased from that sale. And then our accounts receivable, we are going to credit that. We're going to decrease our accounts receivable for $69.80 for the total amount because now Lake Automotive does not owe us that much money anymore. So our accounts receivable credit should be for the total amount. We're going to debit our sales returns and allowances just for what was returned. And then our sales tax payable is going to be the sales part, the tax part of that return. Here's what it looks like in our general journal then. We're going to start with our date. We're going to put our debit to our sales, returns, and allowances. We have our credit memorandum. That's going to be simplified or abbreviated as CM14. Then we have our debit to our sales tax payable. And then we're going to credit accounts receivable / Lake Automotive for the total amount. We do have that slash in here for our post reference. That's just notifying us that we are going to post that credit number twice. We're going to post it once to our accounts receivable, and then we're going to post it again to our Lake Automotive. On MindTap, when we are recording those transactions in the journal, we aren't actually able to put in that slash, but we will put that in when we are posting. So here is what they're showing us now is our posting. And so posting from a general journal to an accounts receivable ledger. So we should be posting to our accounts receivable ledger and then to our general ledger. And so that's why they're showing us here that they're only posting this credit to Lake Automotive first, because that's our only accounts receivable in this transaction. So we're going to Lake Automotive. We're putting in our date. G12 stands for General Journal, page 12. We're posting that credit of $69.80. We're going to find our new balance. We had a debit. We're crediting, so we are subtracting to find our new debit balance. And then we're going to take that account number and we're going to put it up on our post reference on our journal. Okay, they don't show us posting of that general ledger at this point. So we're going to go on to our next thing where it says correcting errors in subsidiary ledger account. So on December 26th, it said that we found that a sale on account to Skinner College was incorrectly charged to the account of Wells Apartments, 334 Memorandum number 44. So they are showing us that correcting entry then. So what we're doing here is that we should have debited Skinner College in that original transaction, but we did not debit it. We debited Wells Apartment instead. So we need to get rid of that debit to Wells Apartment. So we're going to write the date. We're going to write the name of the correct customer. We're then going to put in that source document. Clicking ahead here. We're going to put in that source document. We're going to put in the correct debit then of $334 to Skinner College. Then we're going to put in our incorrect customer. So the one that we incorrectly charged, which was Wells Apartments. And then we're going to put in that credit of $334 to get rid of that original debit. They're now showing us the posting as well. So posting, we have our date, G12, General Journal, page 12. This case, Skinner College has a debit of $334. We have a debit and a debit, so we're going to add to find our new balance. That account number then goes back up to our post reference. For Wells Apartment, we're going to put in the date, G12. Here we have a credit for $334. We have a debit and a credit, so we're going to subtract to find our new balance, and then that account number goes back up to the post reference. Here we can see on this one, the 22nd was when we incorrectly recorded that debit to Wells's Apartment. So really what we're doing here with this credit is we're getting rid of this, because when we credit this, these two cancel out. Number one, what is the difference between a sales return and a sales allowance? A sales return is going to be credit allowed to a customer for the sales price of returned merchandise. A sales allowance is credit allowed to a customer for part of the sales price of merchandise that is not returned. So in this example, they say like a shortage in a shipment. Number two, what is the source document for journalizing sales returns and allowances? We're going to use a credit memorandum. Number three, why are sales returns and allowances not debited to the sales account? We don't want to just debit them to the sales account and decrease that sales account, because we want to acknowledge that there was a sale that was made and then merchandise was returned. Okay, so this is to provide better information, enabling management to quickly learn if the percent of sales returns and allowances to sales is greater than expected. So we are expecting that there are going to be some sales returns and allowances, but what we want to monitor is that going up? Is that greater than what we thought it was going to be? And if that is, why? What's going on that we have so many returns or allowances that we're giving? Number four, which general ledger accounts are affected and how by a sales returns and allowances transaction? So we would have a debit to our sales returns and allowances, and we would also have a debit to our sales tax payable. We would then credit our accounts receivable. And here in the question, they're only asking us for our general ledger accounts, we would also be crediting that customer as well, but that's not a general ledger account, so that's why we did not include that in the answer. Okay, that was the end then of 11.2. You can now go on to the 11.2 work together.